ETFs, a beginner's guide to exchange-traded funds. Exchange-traded funds, ETFs, have become a cornerstone of modern investing, offering accessible diversification and low costs. This guide breaks down what ETFs are, how they work, and why they matter for both new and experienced investors. What is an ETF? An ETF is essentially a basket of investments, stocks, bonds, commodities, or a combination that trades on a stock exchange like an individual stock. When you buy one share of an ETF, you own a slice of every asset held within that fund. This instant diversification is a major benefit, letting you spread risk across dozens or hundreds of companies without picking individual stocks. How do ETFs work? ETFs pool money from multiple investors to create a portfolio, usually designed to mirror a specific index, like the S&P 500 or investment strategy. Fund managers don't aim to beat the market. Instead, they ensure the ETF stays aligned with its target. For example, an S&P 500 ETF adjusts its holdings only when the underlying index changes. Unlike traditional mutual funds, ETFs trade throughout the day at live market prices, giving you flexibility to buy or sell when you choose. What can you invest in with ETFs? The range of ETF options is vast. Stocks, the most common type, tracking broad market indexes or specific sectors. Bonds, fixed income ETFs provide exposure to government or corporate debt. Commodities, gold, oil, and agricultural products can be held through commodity ETFs. International markets, invest in foreign stocks without currency conversion hassles. Cryptocurrencies, recently approved Bitcoin ETFs allow direct cryptocurrency exposure through traditional brokerage accounts. Key ETF types: index ETFs track major benchmarks like the S&P 500 or Nasdaq 100. Sector ETFs focus on specific industries, technology, healthcare, etc. Dividend ETFs prioritize stocks with high dividend yields. ESG ETFs invest in companies with strong environmental, social, and governance practices. Actively managed ETFs. Fund managers make investment decisions instead of passively following an index. ETFs versus mutual funds. What's the difference? The main distinction is how and when you trade. ETFs trade like stocks continuously throughout the day. Mutual funds are priced once daily after market close, bought directly from the fund company. ETFs are typically passively managed with lower fees, while mutual funds often involve active management and higher costs. Both require a brokerage account. Benefits of investing in ETFs: instant diversification, reduces risk by spreading your investment across multiple assets. Low costs. Expense ratios, annual fees, are usually lower than those of mutual funds. Flexibility, trade anytime the market is open. Tax efficiency, ETFs can generate fewer taxable events than mutual funds. Risks to consider: market risk. ETF value declines if the underlying index or sector falls. Sector concentration. Sector ETFs expose you to a single industry's volatility. Expense ratios, while small, fees still exist. Dividend yields. Broad market ETFs may offer modest income. How to buy ETFs. Buying an ETF is as simple as buying a stock. Open a brokerage account. Fidelity, Schwab, Vanguard are popular options. Fund your account. Search for the ETF you want and place a trade. Look for zero-commission brokers to minimize costs. Compare expense ratios and historical performance before investing. Popular ETFs to consider: April 1, 2026 data, SBDR S&P 500 ETF Trust, SPY, tracks the S&P 500. Expense ratio, 0.09%, Vanguard S&P 500 ETF, VOO, low-cost S&P 500 tracker. Expense ratio, 0.03%, iShares Core S&P 500 ETF, IVV, another low-cost S&P 500 option. Expense ratio, 0.03%, Vanguard Total Stock Market ETF, VTI, tracks the entire U.S. stock market. Expense ratio, 0.03%, Invesco QQQ Trust, QQQ, tracks the Nasdaq 100 tech-heavy. Expense ratio, 0.2%. Choosing the right ETF. Start by defining your investment goals. For most beginners, a broad market ETF, VOO or VTI, is an excellent starting point. As you learn, you can add targeted funds to diversify further. Disclaimer: ETF data is subject to change. This information is for educational purposes only and not financial advice.